The market profile has been part of the standard equipment of every professional trader for many decades and is still the absolute standard on every major prop trading floor in the world. Invented in 1985 by soybean trader Peter Steidelmeier, no other tool is as useful as the market profile for analyzing market structure and understanding the auction process. The market profile shows us how much time the price has spent at certain prices within a certain time interval. For prices that have been traded frequently and over a long period of time, the profile will be correspondingly wider. For prices that the market has passed quickly, we will only get a very thin profile. For some years now, the volume profile has also been enjoying increasing popularity. In contrast to the market profile, it does not measure time, but rather, as the name suggests, how much volume has been traded and accumulated at certain prices within a certain period of time. The volume profile thus shows us where actual trading has taken place. In relation to the market profile, the volume profile is often much more detailed and allows us to use a magnifying glass to precisely identify trading opportunities at individual prices. For our market analysis, we use both profile forms equally to find trading areas based on auction theory, where institutional trading parties have become active and which are highly likely to be defended by them should the price return to that point. Let me try to summarize this auction theory quickly and concisely. At prices that are perceived as fair by both buyers and sellers based on the current market situation, a lot of mutual trade will take place. As a result, a lot of volume will accumulate here and the volume profile will develop a wide range. As soon as the price moves away from this fair price, the market becomes less and less attractive for one of the two parties. Imagine you are at a real auction at Sotheby's and you want to bid. At the beginning, while the valuable item is still affordable, many hands will rise and place a bid. The more expensive it gets, the fewer bids will be placed and the fewer participants will be willing to pay the price. At some point, the price has risen so high that only one party is still bidding and they get the item. The stock and futures markets work in almost the same way, but with a significant difference that you can both buy and sell. In principle, the price can move permanently in both directions and not just upwards, as in a real life auction. We've already established that there will be prices that are perceived as attractive and fair by both buyers and sellers. At these prices, mutual trade takes place. A lot of volume is traded and the price behaves largely arbitrarily, which is uninteresting for us in terms of trading opportunities. Here, large trading parties build up their positions and hedgers take the opportunity to hedge against price fluctuations. If the price moves upwards out of this range, it becomes increasingly unattractive for buyers, and sellers will increasingly try to unload their goods. At some point, we reach a price range that we call the premium. Here, there are hardly any willing buyers and trading activity decreases. The same thing happens when the price drops from the fair value. Buyers become increasingly active here to take advantage of the low prices. However, there are successively fewer and fewer sellers willing to sell at the lower prices. Here too, the trading volume will gradually decrease until we finally reach the so-called discount area, where there are hardly any sellers left. This trading behavior creates the well-known peaks and troughs in the profile. In our analysis, we look increasingly at historical discount and premium price ranges, and using the profiles and the order book, we can identify prices that are highly likely to be defended by institutional market participants and at which we can expect high volumes if the market returns to them.